It's 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman, and here are the three things that you need to know to start off your morning. Fears over China's economy dominated headlines this week, and the pain extends beyond the grim economic data. Concern over a liquidity crisis centers around financial conglomerate Zhangji, known in the nation as a shadow bank. Reports suggest it may need to restructure its debt, stoking fears it could trigger a wider string of defaults. Reports from Lenovo, Tencent, and Xpeng also paint a picture of a slumping demand and weak consumer. And fears of higher for longer rates are adding to the risk-off sentiment for investors. The Dow is heading for its worst week since March, and it's likely to be oil's first weekly loss since June. Hawkish-sounding Fed minutes and resilient data are part of that story. The U.S. benchmark 10-year yield hit 2008 highs this week, though it's ticked down a touch heading into the weekend. And this week's corporate results painted a mixed picture on the health of the consumer. Walmart raised its profit outlook again as shoppers looking for bargains boosted sales. It came as Target cut its full-year forecast for the top and bottom lines on weaker sales. Next week, attention turns to Nvidia's results. Last quarter, the tech giant blew the street away with its outlook and commentary around AI. It'll be a tough act to follow.
So what did we learn this week? First, shoppers have been more cautious, focused on trading down and buying lower priced items. Walmart won big, while the more discretionary leaning Target saw sales slump.
Second, the rates debate is, alive and well. The 10-year Treasury yield saw its highest close since 2008 after Wednesday's Fed minutes suggested officials are still focused on containing inflation.
And finally, economic woes abound in China. The world's second largest economy is still struggling to recover post-pandemic. China's central bank cutting key interest rates on disappointing economic data, and new fears of a looming property crisis there from mega developers Country Garden and, I guess, the ghost of Evergrande, you could say, after it filed for Chapter 15 bankruptcy protection in the U.S. That is not helping matters either. So a pretty eventful week for a summer August week, right? But I think whether you look at any of these three factors, they're not just a 1 week story, right? Whether you're talking about the consumer, whether you're talking about inflation, the Fed, and the trajectory for bond yields, or whether you're talking about China, these themes are gonna be lasting.
Yeah, three types of woes in different area codes here. As we think about specifically the consumer, though, and what we were hearing from some of the larger retailers over the course of this week, many of them trying to glean as best as they could into the back-to-school shopping season and see what that sets up in terms of a demand profile for consumers and the propensity to spend going into the holiday season. And that really gets us to the crux of some of the forecasts that we heard. And Target really jumped out. And even though you did see some interesting stock price movement in reaction to the earnings where they did lower that guidance, I think critically here, Walmart may have saved some of that tenor at least. And it really is about where the consumer is going to be spending, where they're looking for discounts. We spoke with Tanger Outlets CEO as well, and he laid out a picture saying consumers are clearly looking for sales and discounts right now. So it's a matter of which brands are being able to not just manage inventory the best in this retail environment, but also make sure that the pricing strategy is such that consumers will continue to feel comfortable spending their dollars, those discretionary dollars, where they had shown some weakness coming into this year, especially in that apparel and footwear category too.
You know, I keep coming back to the comment that Simeon Siegel of BMO made to us, where he talked about that because of normalization in inventory right now and more of a normalization of the environment, it's going to be more about management execution on the part of retailers. So that begs the question of, is Target a macro issue of people really looking to save money? Or is it a Target issue? And I don't think we have the answer to that question yet, but we do have a few other clues. Firstly, we did have Walmart saying that there is a little bit of purchasing of big ticket items coming back in, a little bit, even though Home Depot said the opposite. We got retail sales this week as well, and those numbers were quite strong, particularly even online, yes, but even for things like apparel. So how is that going to play out beyond a Target, which has seen in the past strengthen its apparel business? How's that going to play out for the specialty retailers when we start to hear from the Gaps of the world? Now, Gap has its own issues, but how is that going to start to play out when we hear from more of those companies? So there's sort of all of these hints and still questions about, it's not that people are pulling back on their spending. I think the retail sales number made that clear.
Sure.
It's still that they are spending on certain things. Are they spending more on travel and therefore will only buy clothes on sale, for example. So, I think we're still getting a bigger picture for all of this.
Or only buy t-shirts that say I love New York on them, who knows? But for the Fed and how they weigh all of this data, it's been amazing to see even in the minutes and how they were discussing the state of the consumer coming into their last meeting and what that sets up for September and November, and a lot of the signs pointing towards a potential November hike. And even if we do have a muted decision in September here, the way that the Fed has been talking about this, as shown through their meeting minutes over the course of this week, that certainly had some price action in the bond market and the yields, particularly saying that consumer price inflation as measured by the 12-month percent change in the price index for PCE remained elevated in May. Available information suggested that inflation declined but remained elevated in June. And so since then, we've also had July's reading, and now we're thinking about where the Fed will continue to need to dampen down on, of course, that chart right there, that larger trend, the inflation rate, and their target. Remember, folks, 2% is what they're going to be looking for here. And so will the Fed be comfortable with us remaining around this 3% ballpark, at least for the time being, while they wait to see if their policy that is enacted has fully been digested, and at what point will they believe it's fully digested?
One thing that maybe will get it a little bit closer to being digested is we saw an increase in mortgage rates and 30-year mortgage rates this week. And so that's something that eventually we could see weigh on consumer spending. Especially, we got a little bit of a warning perhaps from Canada in the form of Doug McMillon, the CEO of Walmart, making commentary about Canadian customers being a little more cautious. Apparently, the mortgage market there is more short-term mortgages than it is here in the U.S. And so then they are starting to feel the pinch of higher rates a little more. That's moving its way through the system a little more quickly than it is here. I thought that was a really interesting comment.
To that, I say, hey, all right. With the property crisis also came corporate concerns here in China. Lenovo, Tencent, and Xpeng all painted a difficult picture for China as a rocky economic backdrop led to slowing demand for some of the country's largest companies. Paul Christopher, head of global investment strategy over at Wells Fargo Investment Institute, joins us now. Paul, great to see you here this morning. Thanks for taking some time. Let's kind of look back at the week that was in China and what that really sets up for what's next to come on a few different fronts. And perhaps we can start with the action that perhaps might take the markets by storm here if there is continued surprising activity out of policymakers in China.
Well, the China story is a difficult one, and it's weighing on investors here in the U.S. right now. It's a familiar story. It's post-pandemic there, right? So if you go to China, you'll see long lines outside of popular restaurants, tourist spots as packed as ever, train and airline tickets harder to come by, the catering business doing really, really well. But what's suffering there is private business. Private business is just not really sure where things are going next. They're struggling to contain costs, to make money. They're struggling to survive rather than to expand. And then there are these problems with the property developers and the local governments that have borrowed so much money to transfer land or I guess transform land into property. So those are the big problems, and those are weighing on China. Trade from China to the U.S. is down as well. That's not helping. And so you're getting this little bit of deflation coming from China to the U.S., worries about debt there. And that weighs on investors here, just as interest rates look like they're set to go a little bit higher. So it's a kind of a typical hand-wringing sort of August, where a lot of people are on vacation and some of the worries start to close in.
Yeah, this always does happen in August, doesn't it, Paul? I heard one commentator this morning compare China in the capital market sense to a minnow. In other words, it's an economic giant. A lot of U.S. companies have been relying on the country for a part of their revenue. But in terms of sort of financial markets contagion, perhaps not as much a concern. Can you sort of put all of this in context for us, how investors should be thinking about the China issue right now?
Well, it's an apt sort of image of a minnow. China, like many developing countries, has focused its rapid growth on a lot of bank lending, and it's government-directed bank lending. So the government tells the banks who gets the money, who gets the capital. They have a stock market, yeah, sure. A lot of that, though, that stock market is run by insiders. corporate executives. They're the ones who are doing a lot of the trading. Increasingly, international investors have come to that market, but it's a very up and down market, a very volatile market. So in terms of where private firms can get capital, it's difficult if you're not already on the government's list.
And so if we were to look back towards, anything that is similar to or analogous to what China is experiencing right now and try to paint a picture or a correlation at least between where other markets in the world, how they reacted back then, is there any historical correlation that we can point to?
Well, it's a little bit early for that probably, but one thing that's I'll say in the corner of the eye for a lot of investors is whether or not China is following the path of Korea and Japan. Countries that after their respective wars in the 40s and then in the 50s developed very quickly, especially through the use of government-directed bank credit, so government-directed industrial policies. And inevitably, government-directed policies will get some things wrong. They'll put money where it shouldn't be in bad businesses, bad industries. And so the debt gets to be too high, and then there has to be a consolidation. The debt has to be written off. And so that's the concern with China's property market right now, is that there will be debts that the government can't handle. I don't think that's really the case, at least not yet. We've seen this with Evergrande before. I think the Chinese government can do what it needs to do to hold stability there, but they do have some consolidation that they need to do in the coming years if they're going to right the ship in terms of how they use capital and how they use debt in China.
So, Paul, we have seen some recent flows away from China, at least U.S. flows sort of away from China. Do you think that U.S. investors should stay away from investing in Chinese companies, A, and B, should they also be cautious of U.S. companies that rely heavily on China?
Well, it's difficult because of the lack of transparency in China, and now that Beijing and Washington are playing one-upsmanship in terms of restrictions on companies and restrictions on investment, it becomes even more difficult for U.S. investors, any foreign investor, to make an investment in China where he or she kind of has a good idea of what the playing field looks like and how the rules of the game are going to work in the coming years. Having said that, though, there's still a lot of U.S. companies in China. And so let's say there's a retired U.S. investor who wants to maybe play into Chinese growth going forward. It will be a growing economy going forward. And one of the ways we've been suggesting is through U.S. multinationals that still have business there. Some have pulled out, many are still there. So that would be a way to let the big U.S. multinational manage the exchange rate issues, manage the labor issues, manage the regulatory issues, which are becoming increasingly onerous. But we're underweight emerging markets right now, including China. That means we prefer to have our money here in the U.S. And to some extent in Europe and in Japan. So we wouldn't be going to China first. I just wouldn't like to rule it out completely.
What do you believe the consumer in China needs to feel in order for spending to really be reinvigorated?
Well, there's a couple of things. One is that property is extremely expensive. And in China, one has to put down a big down payment in order to get the property, the building started. And the property companies right now have a lot of debt. And so it's a very iffy proposition. You give someone a big down payment. Will that down payment turn into a house? An apartment, or will that company just go bust and take your money down with it? So that's one big problem that the Chinese have, the Chinese consumer has. Another big problem is, will the Chinese worker have a wage? Will the Chinese worker have a job? Unemployment, especially among the young, is very high in China right now. And there have been lots of people, small businesses too, that have lost their incomes, lost their livelihoods. And it's not exactly clear how soon they'll be able to reclaim those.
Paul, stick around for a moment. We want to turn to another topic. President Biden's CHIPS Act and the Inflation Reduction Act both turned one this month, the IRA this week, in fact. Goldman Sachs is ready to celebrate, in a manner of speaking. Analysts there released a note this morning laying out the boost they expect these laws to add to the economy. Companies jumped to take advantage of new tax credits and subsidies, announcing plans to build facilities in states across the U.S. So Goldman now expects construction of manufacturing facilities to jump 10 to 15% through the end of the year. And with that, they raised their manufacturing structures investment forecast for the full year to 6.3%, equipment investment forecast going up to 2.1%, and therefore real GDP to 2%. They also see manufacturing jobs growing by about 2%, or 200 to 250,000 jobs over the next 2 years, thanks to this investment. Joining us now is Yahoo Finance senior columnist Rick Newman. I don't know what all of that does to inflation specifically, Rick, but it is interesting as we look back on the 1-year anniversary of these various acts, what kind of economic contribution they have done so far and are expected to do.
Yeah, this is a continuing story out of Goldman and some other analysts as well. Those two laws, the Semiconductor Act and the Green Energy Program, which was misnamed the Inflation Reduction Act, those two laws are moving the needle on reshoring. We've been talking about reshoring for probably 30 years or more, and it is finally happening. So what we know about the Green Energy Law is the estimate when that law passed was that the green energy tax credits would add up to about $385 billion. But those tax credits are mostly uncapped. There's no dollar limit on the amount of tax credits. The estimates a year ago were simply based on guesses on the uptake by companies, how many companies would actually apply for those credits. And it turns out that many more companies than expected are applying for those tax credits, which means there's a lot more private capital coming in to build battery factories, components for electric vehicles, and semiconductor facilities. So latest estimates are the total amount of those tax credits over 10 years could be more than $1 trillion. So uptake from the private sector is about 3 times what's expected. So Goldman is now pushing that to the next level and say, okay, what's the effect of all that likely to be on investment in structures, as you saw, also investment in equipment, and how many new manufacturing jobs are going to happen? So we are having a factory building boom in the United States, and what's likely to happen next, which is what Goldman is now forecasting, is lots of investment in the equipment that's going to go in those factories and a lot of hiring of manufacturing workers.
Is it clear when much of the capacity is expected to be brought online, Rick?
So what's happening right now is we're in a construction boom, but if you look at manufacturing employment, it has actually been flat for this year. So this is not yet showing up in employment, but when they're building the factories, they're building it. So if you build it, they will come because they have to come to fill those factories. So I think this is going to be a sustained boom in manufacturing, probably for the next 10 years. That's the life of the tax credits in the law. I think if you're President Biden, you would like to see a bump in manufacturing employment by this time next year, when we're just a couple of months away from the 2024 election. That seems plausible. And you could see a sustained, boost to manufacturing activity and employment, I think, for the next 8 to 10 years.
Of course, some of that is going to be contingent on training those workers to do those jobs also. But
and finding them in the first place.
Yeah, exactly.
There's no guarantee that those workers are even there.
Yeah, very true. The administration has talked about training workers for those jobs as well. Thanks so much, Rick. Appreciate it. Let's bring back in Paul Christopher of the Wells Fargo Institute to sort of talk about the economic prospects here, both from the act and more broadly. I am curious, Paul, how much you are looking at these potential areas of growth and looking at them as investable opportunities over the next year or even 5 to 10 years.
Oh, we do believe that that's going to be the case. And currently, 2 of our favorite sectors are materials and industrials. You wouldn't think that we would recommend to ordinarily very cyclical sectors just ahead of what we think will be in a continued slowdown and probably a recession here in the U.S. But the real drivers of those 2 sectors, we think, will be these long-term trends towards factory building and more reshoring in the U.S. I do want to caution, though, that I don't think that we're going to see all of those supply chains from Asia come back to the U.S. There'll be a lot of friend shoring as well, or what we call near shoring, where Mexico could benefit, other places in South America could benefit. It's just not going to be possible, we think, to bring all that manufacturing back to the U.S. and do it on a cost-efficient and competitive basis.
So from an investment standpoint, what sectors could be immediately benefited as a result of some of these major investments?
Oh, definitely industrials and materials, as I mentioned. Eventually, technology too. We think technology is a little bit expensive here right now. We took some profits on it in June and went back to a neutral or market weight for information technology. But what'll end up happening is that you won't be able to find workers for all of those jobs, and you'll end up having to use quite a lot of technology, perhaps some artificial intelligence, very, very likely robotics in one form or another, automated sorts of other equipment, trucks, for example, that's on the horizon too. So ways to supplement the workers that are already going to be hired for that kind of work. Those will be key sectors to watch going forward. IT, communication services, consumer discretionary. We're not quite ready yet to make those purchases, to make those favorites, but definitely materials and industrials for right now.
Yeah, and that's really interesting that call, you're making that call, as you said, despite the fact that you expect some slowing in the overall economy. What other areas are you looking at, sort of separate from the nearshoring, reshoring thesis, that you think are going to be more helpful in a slowing environment?
So one of the areas that you want to go to late in the cycle while the economy is still growing, and it is still growing, would be what we would call quality sectors. Those would be sectors that we think have good prospects for and let's call it to generate their own revenue going forward, and then to pay investors through dividends. And so these quality sectors, ones that won't just go up and down with the economy, but that have some staying power in terms of revenue generation. Think healthcare, for example. Earlier in the year, we were favorable on energy. We took some profits there recently as well. That would be another sector that we think generates a lot of cash and can pay investors. So those quality sectors here late cycle supplement the industrials and the materials that we think are very interesting as the industrial sector builds out to reshore. So it's kind of a combination of factors there driving those picks.
We talked about finding workers and the need there. At what wage as well? And is there a correlation there between the wage that those workers who are moving into some of these manufacturing and industrial positions as well are willing to accept, alongside what the inflationary picture looks like on the other side of that, given the correlation that we've seen the Fed pay close attention to where wage increases or wage growth has continued to move?
So wage growth currently is running at about 4% on a 12-month basis. That's just a little bit higher, a little bit hotter than overall inflation. And so wages are obviously going to contribute to inflation here in the shorter term. But in the longer term, what we would expect to see is that these factories have to be more efficient than they have been in the past. So they have to be more efficient than the U.S. factories that closed down and went to Mexico and China 20, 30 years ago in the first place. And as those efficiencies work their way through, including artificial intelligence, we believe, you'll see productivity by workers increase. And that will, we think, allow wages to increase without generating additional inflation. So over the longer term, we think that's the path forward for U.S. manufacturing. Here in the shorter term, that 4% wage growth is a little bit of a problem, and it's being driven not just by manufacturing, I would say even more by services, especially hospitality services, where workers are scarce. So a lot of different things happening here, both in the short-run drivers, like the demand for restaurants and hotel and travel, and then longer term factors like the reshoring and the increase in productivity that we expect over the longer term. So very interesting opportunities here, short and long term, for investors.
I was waiting for that AI mention, Paul, and you delivered very clear, thank you, in terms of laying out that long-term and short-term theses. Thank you so much. Paul Christopher is head of global investment strategy at the Wells Fargo Investment Institute. Have a great weekend.
Thank you.
We got much more markets action coming up. Stay tuned. You're watching Yahoo Finance. Let's check on some of the movers that we are keeping an eye on ahead of the bell. Deere shares are down almost 1.5% now. If you listen to the numbers here, it doesn't really explain why the shares are down, so stick with me here for a minute. The company saw global net sales and revenue jump 12% year over year, and the farm equipment maker also set its profit guidance above expectations for 2023. Some of the other numbers look good as well here. The company's earnings per share also beat estimates, and the company's CEO John May said fundamentals are expected to continue fueling solid demand for our equipment, supported by a strong advanced order position. So, why are the shares down this morning? It looks like there is some concern. I've been looking at some of the analyst commentary that maybe there's concern about a peak in the agricultural cycle here, and perhaps that is what's going on with the weakness in the shares.
Interesting. I'm looking at some of the industry outlook for fiscal 2023 that the company had published within its press release, accompanied with the earnings results here. And it's looking, at least in the agriculture segment that we're thinking of, large ag, that's looking, and they're expecting that to come in up to about 10% there. Small ag and turf, expecting that to actually be down by about 5 to 10% in their forecast here. And you think about what has been fun to talk about quarter in, quarter out, which is production and precision ag, precision agriculture. I don't know, I was trying to be hip with the lingo there and how the industry discusses it.
I think that's more professional, right? Versus the small ag and turf would be more small, maybe landscapers, just your little power mower for your lawn, maybe.
Well, no. I mean, according to Home Depot, I've got to get the new robotic mower, the RoboFlow or something like that. We'll figure that out in the name of it later. I've got it in a tab somewhere. But production and precision ag, you certainly do see that business-to-business correlation as it comes through some of the results there, and particularly operating profit up 38%, in that represents the lion's share of their revenue that they see come in, which for this most recent third quarter was about $15.8 billion here. Production and precision ag, that percentage of it, or at least the makeup on a dollar basis, $6.8 billion worth of it. So net sales up there by about 12%. No doubt investors going to be paying close attention, not just to what happened in this most recent quarter, but also, to your point, what analysts are expecting that real forecast to perhaps marry up to.
Yeah, and just to mention a couple of other things in that small agriculture and turf segment in particular, the company said all of its gains came from higher prices because volumes were down. The other two segments, that is construction and forestry and the production and precision, both of them saw improved volumes as well, but not in the small area. So that's one area to watch as well when it comes to Deere.
Yeah.
All right.
Company.
Yeah. Well, let's talk about the opening bell on Wall Street here. To end the week, how are we setting up? Not great if you're a bull in these markets. Nasdaq trading lower by almost 1%. The S&P and the Dow also taking a hit. And, you know, investors likely doing what we did at the top of the show, sort of taking a look back over the week, looking at bond yields that remain near their highest going back to 2008, looking at a consumer picture that is somewhat muddied, if you will, consumers being choosier here, and of course looking at the situation in China as well, and all of that perhaps weighing on things as we close out the week. You're looking pensive there, Brad, as I enumerate those various things affecting the market.
Yeah, I'm just trying to really get my head around what's taken place over the course of this past 5 days. Take a look at the Dow. It's down by about 2 3/4% over the past 5 days here as we've been tracking it. Out the gate this morning, it's down by about 0.4% here. So a little bit of hesitancy, a little bit of caution here on the markets. Take a look at the past 5 days for the Nasdaq Composite. You're seeing that down more than 3%. Here today, down by about 1% at the open. And the S&P 500, if you were looking for reprieve there, you're not going to find it. It's down 2.7% over the past 5 days. Here this morning, down by about 0.6%. Let's take a look at the sector activity here, give you a good sense of what's taking place out the gate, and perhaps I'll take a look at the past 5 days there too. All right, red across the board. So let's just take a look at that past 5-day movement here, and more red, in fact, deep red. XLY, consumer discretionary, and especially as we've got some of those retail names that have reported, some of the largest retail companies, I might add, here in the U.S. have all put out those results over the course of this week, whether they're a discount retailer or full price retailer. It's been interesting to see where those results have come in and the guidance that they put forward. But XLY, consumer discretionary, that's down by about 4.6% over the course of this week. Nothing's in the green, but the best of the worst, I guess. Healthcare, that's down by about 1.8% over the course of this week. And then just lastly here, I'm going to put this back on an intraday look just to see where some of that mega cap tech move is. And we won't linger here for too long because there's a lot of red there too. You're taking a look at some of the deepest decliners coming in the form of, and yeah, this will give you a little bit of a sense of how much uncertainty still remains with that Chinese consumer as well, or the Asia Pacific consumer. Right now, JD.com, you're seeing that down by about 5.5%. And just while I'm remembering to hit that one, JD.com has had a bad week too. That's down by about 9.7%. And so continue to track that Pinduoduo as well. You're seeing that down over the past 5 days by about 6% here today. One of the biggest laggards on the Nasdaq 100. Julie?
Yeah, I'm just looking at some of the numbers on the week. So it's the third straight down week for the Dow and the Nasdaq 100. The Nasdaq 100 is off about 8% from its high it reached on July 18th. The S&P 500 down almost 5% from that level that it reached in late July, its high for the year. So we've definitely been seeing this pullback continue for the major averages, and the Dow not doing so great either.
Yeah, this is a quick month-to-date look at the Dow 30 components there. Apple, the biggest decliner there. That continues to be in correction. It's down 11.4% over the month.
All right, let's take a look at some other movers here. Estee Lauder shares are sinking after the beauty brand gave guidance below expectations for the full year and signaled slowing recovery in Asia, along with a pullback in demand in the U.S. In Asia, that's been a particular issue for the company. It's now saying that 2024 adjusted earnings per share will be at most $3.70. That upper end of the forecast is below estimates. Sales this year expected to rise 5 to 7%.
Yeah, they said that they returned to organic sales growth in the fourth quarter, delivering their outlook. Momentum continued in the markets of EMEA and Latin America, accelerated strongly in Asia Pacific, led by mainland China and Hong Kong. Particularly here, though, some of the other figures that investors might be looking at this morning, even given the stock price reaction that we're seeing to some of that forecast. Full year net sales, they decreased 10% here, and the diluted EPS, which is what you should be paying attention to, or adjusted EPS, that decreased 57% for the diluted EPS, and then organic net sales, that was down 6%. So really just not a good quarter here, and I think more largely is the expectation of when they will finally return to organic net sales growth and margin recovery, and they're not expecting that until fiscal 2024 here for them. So
yeah, well, all of that explains why the shares are not doing so well today.
Not good, not good.
Speaking of which,
let's also talk about Farfetch. This one, an interesting company, a fun one to keep tabs on here. One of my favorite.
Not fun if you're long the shares today.
Yeah, I mean, the fun is an absolute value, I guess. Because it's enjoyable to talk about when there's a lot of moves. However, here we're taking a look at one of the moves that is downward-facing dog for Farfetch. Lower by about 38% here, plunging after the company's revenue came in below expectations and issued weaker than expected guidance. The company was also hit with downgrades from JP Morgan and KeyBank on the back of disappointing results here. And there you're taking a look at some of the actuals versus the estimates and I guess a mixed bag in terms of the adjusted EPS not being as bad as it could have been, but still a loss here. And this is a particularly timely conversation. The Farfetch chief financial officer saying, interestingly, they're pleased with the second quarter performance, demonstrating progress towards delivering profitable growth, positive free cash flow in 2023, digital platform performing well, returning to growth while maintaining a stable order contribution margin. Compare that to the conversation that we had with StockX CEO Scott Cutler earlier this week, who we put the question to just about where they're seeing moderation in perhaps some of the prices that consumers are willing to pay, especially within that kind of resale or circular economy where people are listing high value goods in a marketplace style. And Farfetch is one of those major players. And as you think about where consumers are even being more discretionary with their dollars, that high value and luxury purchase, especially for kind of the mass market that a Farfetch or that a StockX even might be trying to cozy up to or retain the attention of, that becomes even harder when you hear from companies like Target and Walmart that same customer is now spending more with them and trying to figure out where they can have some cost savings elsewhere.
Yeah.
On a different product.
Right. I know that Walmart talked about getting more high-income customers to its store. I'm not entirely convinced that the Venn diagram of the Walmart.
That they're
and the
losing gaining
Right.
Farfetch customers.
Yeah, I don't know how much those over. I don't know. Yeah. But the numbers don't lie, and the company's saying that its gross merchandise value for the full year now going to be only $4.4 billion, down from its prior forecast of $4.9 billion. That's just not a great situation. Doug Anmuth over at JP Morgan said this was supposed to be the year of execution for Farfetch, but it's been tough in part because of the weakness in U.S. and China. I guess also Farfetch has a partnership with Reebok, and JP Morgan says there have been some early hiccups in that relationship.
Yeah, I mean, the just last bit that I'll add on this too, does Farfetch face challenges in a quiet luxury environment too? We talked with Simeon Siegel about this, and whether or not quiet luxury as a larger trend is something that could have the propensity to affect a company in Farfetch that has a lot of high value goods that are in some cases seen as very flashy goods for consumers.
Yeah, I guess so. I mean, I
purchase.
think non-logo is mostly what we're talking about, but I guess also sort of obvious from a particular brand or not. I don't know.
I mean, the Gucci flip-flops that are in my cart, everybody's going to know that they're Gucci. I'm just not, I can't buy them yet. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. We're set to commence yet another earnings season, cyclically here, of course, on that rolling quarterly basis. As we think about what the theme could be for this earnings season, what jumps out to you?
I think it's going to be about future guidance. And so the theme, I think we could still see some of that AI, a lot of balance sheet management as well, just given the fact that we are in this higher for longer interest rate environment. But I think this earnings season is particularly important about the future guidance, what going into the second half of the year, because right now, well, the market's anticipating a decline in Q2 earnings of about 7% year over year. The second half of this year looks a little bit too rosy to us. And so I think it's all going to be about future guidance for the second half.
Welcome back. Bitcoin has recovered slightly after briefly dipping below the $20,000 mark following reports that Elon Musk's SpaceX had offloaded the cryptocurrency. Another event you need to keep your eye on today. A major options expiry. Yahoo Finance's Jared Blickery joins us from the floor of the New York Stock Exchange to really connect the two and break it all down for us. Jared.
Yeah, I think the big question in crypto is there a whale selling right now? It would appear so. Bitcoin has been relatively quiet recently. And let's go to the Wi-Fi Interactive and chart the recent price action. Here we can see Bitcoin down 7.44% over the last 24 hours. And here is a 3-month chart. And I was standing here yesterday afternoon, close to the close, just remarking how it had come down to the bottom of this channel, and we were looking for a potential rebound. That did not happen. There was just a washout all the way down to about 25,000, which happens to be about the 3-month low. Let's take a look at the year-to-date chart. We had what could be considered a bullish flag here, but that is out the window. We just have more choppiness inside this range. And there are a lot of expectations when Bitcoin first headed north of 30,000 and then again thinking, well, we're going to get some continuation to the upside, but there's just huge overhead supply there. And apparently it was too much for the market. I will show you the high coincided with this overhead supply, this giant top right here. So still got some things to work through. And now the onus is on the bears to prove the case because the bulls apparently have given up a little bit. But one of the things I've been tracking this week, and in fact over the last 2 weeks, has been the fringier parts of the market, including Bitcoin. I'm going to go to my leaders page here on the Wi-Fi Interactive. You can see for the day, Baito, that's a Bitcoin ETF, that is down the most, followed by Chinese internet ETF, KWeb. But over the last 5 days, we've seen meme stocks and Bitcoin really be two of the big losers this week. Why is that? I think because August was expected to be, and it has turned out to be, a relatively bearish month. We're expecting this to go sideways for the next few months. We also have increasing volatility into September and October. So given the gains that we'd seen year to date, we were ripe for this situation. The big question is what happens next? And that kind of leads me into the next topic you mentioned, which was options expiration, what's going on in the options market. Here I have the S&P 500. You can see we're in the midst of this 5% correction right now. By the way, that's not even, that is more than half of the correction we saw due to the regional bank crisis. That was about 9% or so, and we're just looking at 5 right here. But you take a look at the VIX is picking up, and an analysis by Jefferies out today or yesterday said the pain trade now is decisively to the downside. We saw the Bank of America Fund Manager Survey come out this week where we saw the highest or the least number of bearishness, the least amount of bearishness since February of last year. That was before the Fed kicked off its huge interest rate raising campaign. And so you put all this together, it looks like the bulls have something to prove in this market, and they really haven't for some time. It's been more or less a glide path on the way up. So first substantial correction in a while. We have OPEX this morning. Index options have expired on the open, and now we're waiting until after the close, those last prints of the day, for individual options to expire. There was a lot of put buying, a lot of protection buying coming into this. Put to call ratios, they soared this week. So much for those days to expiration, that phenomenon, and so much for those calls that everybody was buying before. It's all about protection now, guys.
I'm sure that's what everyone is enthusiastically talking about behind you on the floor here this morning.
I have no idea what's going on here. But
I don't know. People are glad it's Friday. I know I am. Maybe that's what's going on. Jared, thank you so much. Appreciate it. Well, in the meantime, investors are getting set for Nvidia earnings. They're set for after the bell next Wednesday. The chipmaker blew away guidance, of course, for expectations for the current quarter in its last earnings report, saying it expected $11 billion in revenue, well above analyst expectations at the time of $7.2 billion. Now analysts are expecting earnings to jump over 300% year over year. So with the expectations this high, can Nvidia possibly deliver? Matt Bryson, Wedbush Securities Senior Vice President of Equity Research, joins us now. Matt, we all know what's going on here, and a lot of your peers on Wall Street have been raising estimates going into this report. It's a lot of weight for Nvidia to carry. Are they going to live up to this?
I don't know that it matters to some extent. So certainly numbers around their data center business have lifted substantially. At the same time, what's also clear is there is a ton of demand out there right now. It's not being satisfied. It takes 40 plus weeks to get H100 GPU from Nvidia. So they've got visibility through Q1 of next year. There's been numerous articles talking about the fact that you can't buy cloud instances. So there's just not enough supply. And so if Nvidia's guide is a little bit light of expectations that have admittedly increased considerably, it just means they'll book more revenue in fiscal Q4 or fiscal 2025. I think the more important piece is how much demand there is out there, as opposed to whether Nvidia can bring on more supply in Q3 or Q4.
And so when we think about where Nvidia is actually going to start to see some of this recognized within their margins, it's more than just what they were spelling out within the demand profile last quarter. When does this start to trickle through to financials? And is it already doing so?
I think it's already doing so. So I think you're seeing margins, particularly for the new H100 chips, that are well above corporate average. When you think about that data center business, it used to be relatively commensurate with gaming business. In my model right now, I've got 8 billion out of roughly 11 billion in revenue tied to data center. If that number goes higher, which is where expectations are, proportionally data center will be even higher. And so that drives more margin. And then within data center, you're seeing Nvidia shift over relatively quickly from their old A100s to the new H100s. Again, I think that drives both ASPs and margins. And then finally, on the OpEx side of things, if you're getting these big upticks, you just can't hire people fast enough. And so you'll see leverage flow through into the operating margin line as well.
Matt, how sort of consistent is this whole switchover going to be? In other words, are you going to see sort of a big rush like we saw reflected in the guidance, and then a little bit of a smoothing out or lumpiness going forward? Or do you think it's just sort of up and to the right here, the demand that we're going to see?
I think for the next 3-4 quarters, it's up and to the right. The question comes down to, you have all of the large CSPs doing a ton of work around training models. You have startups doing a ton of work around training models. The question is what comes out of that model training. So you need to see real use cases that drive substantial amounts of revenue. If those appear, then you're going to get another wave moving from training to inference. So actually running those models, and it's up and to the right for as far as anyone can see. I think there's a good chance you get a pause. So people figure out exactly what they can do with these models. And then you see a jump in inference as that functionality is realized. But it's really hard to say, that pause is going to come in Q2 of calendar 24. It's going to come in Q4 of calendar 24. And so right now, I think the focus is still going to be the up and to the right on this insatiable demand for training.
Matt, one of the other big questions I have around this trend is who else is going to start to benefit more and more as time goes on? We've seen some examples of it, right? And I know you don't cover these, but for example, we talked to a company called Synopsys yesterday that says they're now getting about 10% of their revenue tied to AI. Applied Materials, of course, talking a lot about AI on its call as well. When do we see that in the same sort of magnitude monetarily that we've seen for Nvidia start to move to others?
So I certainly think that for Nvidia revenues to start to continue to grow at these levels, again, you need these models that are being trained to generate real revenue. And so in a sense, the customers of Nvidia's GPUs, like Microsoft and Google and all of these startups, they need to monetize that investment. And so you'll certainly see revenue gains for them. From a supply chain perspective, it's a little bit harder. So we're seeing it in DRAM, where high bandwidth memory is really starting to take off. Right now, Hynix is the biggest beneficiary there, but Micron is certainly adamant that when we get into next year, they'll have products there. TSM is supplying all of the AI chips right now. So from that perspective, they are a beneficiary. But because gross margins for Nvidia are so high, in part because they control both the software and the hardware ecosystem to some extent. They are really the major beneficiary here. And it's not like with other markets where you see their supply chain really benefit when new product takes off, just because they are garnering so much of the profit.
Do you think, though, that investors need to be sort of diversifying their investments within the chip ecosystem or even with the AI ecosystem? Or do you think you can kind of like buy Nvidia and forget it?
I think it's easiest to buy Nvidia and forget it. So until we move, so from a scale perspective, I think it would be a home run for AMD if they're able to do $1.5 billion in AI revenue next year. Similarly for Intel, they're talking about doing a little bit over $1 billion. When you think of Nvidia, right now, people are looking at them doing as much as $10 billion plus in data center revenue in Q3. And then for next year, that number goes up even higher. There's literally an order of magnitude difference between what they're producing and where kind of the combination of their competitors is. And so from that perspective, if you're a real believer in AI, right now, the certain thing to invest in is Nvidia, maybe AMD as well, simply because they're, from a third-party perspective, they're probably in second place. I personally like the memory complex, but that's more because I think there's a recovery in memory next year. AI helps at the edge, but it's not the primary driver in my view.
One horse race. Matt Bryson, thank you so much for your perspective. Obviously, we'll be watching those Nvidia numbers very closely after the close on Wednesday. Wedbush Securities Senior Vice President of Equity Research. Appreciate it.
Thank you.
We got much more markets action coming up. You're watching Yahoo Finance. We got some big interviews on tap in the next hour. Our Retail Week continues. We're going to talk live shopping with the CEO of Shop Talk Live in just a few minutes.
Plus, from retail spending to the housing market, we're breaking down how consumers are viewing the current cost of living. Stay with us. All your markets action ahead. You're watching Yahoo Finance. Has there been one overwhelming theme to this earnings season?
Yeah, I'd say we're about 50% through earnings season, and the theme has really been about 80% of the companies have beat earnings on a bottom line basis. So it does feel like the trend we saw in Q1 continues through Q2. Now, we're still down negative 7.5% or so thus far year over year on an S&P earnings growth basis, but slightly better than expected, and the trend is supposed to improve in the second half of the year. So I'd say net, the good news is we are seeing better margins and better earnings overall in the second quarter.
Buenos. It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman, and we have Rochelle Akufo joining us now. We're about 30 minutes into the start of the trading day here. Let's take a look at how stocks are moving right now. Taking a look first and foremost at the S&P 500, you've got a solid look at some declines right there. It's down by about 0.5% after a long week of data and earnings. We had retail sales post a major surge for the month of July, driven by an Amazon Prime Day perhaps that fueled a boost in e-commerce sales. But results out of retail companies this week were mixed, with the consumer continuing to trade down from big ticket items. We also had the Fed minutes driving yields higher this week as fears of sticky inflation raised investors' alarm bells about the possibility of further rate hikes.
Ooh, a lot to consider. Let's take a look at individual names as well. We are watching Hawaiian Electric. That stock is seeing a bit of a bounce. That's after an upgrade from Wells Fargo to equal weight from underweight. And this comes after the utility company said in a regulatory filing that it does not plan to restructure. It will remain financially strong while seeking expert advice. Hawaiian Electric shares have been hit hard this week, falling over 60% as the company faces a class action lawsuit over the deadly fires in Maui.
That's right. We're also watching Madison Square Garden Entertainment. The company topped analyst expectations in the quarter with revenue up 30% compared to the year prior. MSGE saw revenues tied to the arena's license agreements with the New York Knicks and the New York Rangers decrease by $15.5 million. That's thanks to the change in timing of the NHL 2021 to 2022 regular season.
And we have our eyes on WeWork. The struggling co-working company announced a 1-for-40 reverse stock split this morning in order to regain compliance with New York Stock Exchange listing rules. The stock closed at 16 cents per share on Thursday night, way below the $1 listing requirement. Now, this comes after the company warned last week it has substantial doubt that it can survive as is. It listed that in its risk factors and that its survival hinges on a turn to profitability over the next 12 months.
Right, well, let's talk e-commerce. The surge in e-commerce drove retail sales in July way above analyst expectations. And with our next guest, we're talking about the latest trend in online shopping. Live streaming, like QVC, but on the internet. And it was made popular in China, but now Amazon and TikTok are two of the biggest tech companies right now jumping in to live stream shopping. Now, according to retail consulting firm Coresight Research, the US live shopping market is expected to bring in $32 billion in sales this year. And investors are buying into the trend as well. According to PitchBook, they poured $380 million into live stream e-commerce businesses in 2022. That's up from $36 million in 2020. Our next guest runs one of the companies on the forefront of this trend. Joining us now is Brian Moore, TalkShop Live co-founder and CEO. Good to see you, Brian. I mean, when I see live stream shopping in China, it's literally like QVC on steroids. We haven't quite seen that same adoption yet in the US, but we are starting to see some of it. What is it going to take to see that widespread adoption here?
Well, I actually lived in China for 2 years, studied Mandarin Chinese for 13. So I watched as live stream shopping took off in Asia. And, you know, as we look at the adoption in North America, it's really about the distribution of the content and creating content worth watching, right? Really driving to cut the friction in path to purchase for people as they find content online and really meeting consumers where they consume content.
It's interesting. I do not do shopping this way, but as I frequently do when we talk about something I'm not familiar with, I ask the younger people on my team. And one of them said, well, I don't watch live shopping per se, but I watch haul videos on TikTok where somebody will like go and shop, and that way she sees how something fits someone else, etc. So I guess that brings me to, where are these shoppers that you're talking about when you're trying to meet them where they are and provide, what is the content that is most relevant and interesting to them right now?
Yeah, so at TalkShop Live, we power live shopping from Walmart to Vogue, right? So we work with Condé Nast, Hearst, Dotdash Meredith, Penske Media, also Walmart, Target, Best Buy. And everywhere the video player is embedded, it's shoppable within the video player. So for instance, Jennifer Lopez, when she was doing a beauty secrets video with Vogue, they put it in a TalkShop Live player. It's shoppable on Vogue, but it's also shoppable everywhere the video exists.
So like you can click on the video while it's
watching, and you can engage in the video, ask questions, all of that, and you can execute the sale seamlessly without ever leaving the video.
As a person who interned in a call center at QVC many moons ago, you know, this removes a lot of friction from the shopping experience too. And so for your business model, how do you make money? Where are your margins kind of securitized as a part of this relationship that you're being able to facilitate between a retail manufacturer and a direct consumer, perhaps?
Yeah, so at TalkShop Live, we really connect the retail landscape, right? Because the e-commerce is fragmented online. So we connect the retailer, the brand, the creator, the publisher. And so we monetize on the transaction, but also every step of the marketing funnel. Right, because now what you're starting to see is all of these brands are onboarding to create, I'm sure you guys talk about it on here all the time, but retail media is taking off, right? And all of these brands are now engaging in these retail media experiences that TalkShop Live is powering.
And Brian, I want to ask you, because we had that graphic up about some of the conversion rates. So from views to the cart to the actual purchase, how does that stack up against some of the traditional shopping channels that we're familiar with?
Yeah, we're seeing incredibly higher conversion rates because realistically, when you look online, every time you ask people to click through a link, you lose about 50% of your traffic. And what's so unique about TalkShop Live is we're the only live stream platform that has that sales execution right within the video player on multiple places at once. So for instance, I just saw Oprah pop up, right? When Oprah went live with her book, it was able to be on TalkShop Live across MSN, across many media publishers, and now it's also shoppable on social platforms as well.
I want to circle back to the question that Rochelle asked in the beginning, which is, and you have the experience from living in China, that it is so much more pervasive there. You know, I think we said $32 billion was the number, estimated number this year. It's something like $150 billion in China, so much bigger. What do you think is going to be the tipping point here that's really going to, you know, sort of accelerate that adoption?
Yeah, essentially we're at that tipping point, right? Because it's now adopted by the major retailers. I think we did over 200 shows with Walmart last year, right? It's adopted by the major media outlets, and it's adopted by all of the brands and the brand agencies, brand marketing, and the creators, right? So now what you're starting to see is them to come together and win at live shopping together, and also the power of distribution, right? It's the distribution of content, which I'm sure is something you guys know well, but to drive adoption, people are more apt to engage in live commerce in an area that they know, like, and trust. So your first time experiencing it, if you're a Walmart shopper, experiencing it on Walmart, if you're an Allure reader, experiencing it on Allure. And that's where we're also able to drive through the TalkShop Live content distribution network, 35% more traffic for our retail brand and creator partners through the network that we've created.
What kind of stuff sells the best this way?
So books and music were our gateway categories, right? Every major book publisher, every major record label onboarded to the platform. But now
I saw music list. Just a quick side question on music. Like, people don't buy music anymore. So what were they buying exactly?
But it's everything about music.
Okay,
Well, vinyls are actually on the rise, but it's also their merch. We're now doing tickets for tours, right? So and then the other thing is they're also doing brand deals in these videos, in these shoppable videos. So for instance, we have Lauren Elena on next week. She's doing, kind of like you were talking about the halls, she's doing inside of her tour bus with all products from Walmart. And so that's what you're starting to see, is people bringing people into these live experiences. But the fastest growing categories are food and home and beauty for us. And that's where we're seeing, if you look, basically everybody from the Food Network now has a TalkShop Live channel.
Yeah, I mean, my goodness, you're really giving me some PTSD, thinking back to how many people used to order Kansas City steaks, and then on the other side, the many different hues and shades of nail polishes, lipsticks, and any kind of glamour equipment that would be called in for. You know, all that considered, you're looking at a previous type of delivery, and you talked about the distribution, one that was previously through linear television. And now you've got so much attention that's been, and usership and viewership that's been thrust towards streaming. Does TalkShop Live need to be within one of the large streaming players that's out there, whether it's Hulu, whether it's Disney, whether it's Netflix, and how does that experience catapult you to that next level?
Yeah, and I think what you're starting to see is a lot of them reach out to us to partner with them to drive live shopping experiences. Like last week, there was one with Paramount with Teenage Mutant Ninja Turtles. Okay. You know, and so what you're starting to see is that people are making this a part of their overall plan. And I really believe, because my background is I started the social media department at 20th Television, right? So the way that I look at it is the future of retail is media, and the future of media is retail. And TalkShop Live fits squarely at the intersection there. And what it does is, you know, I think as you look to the future, like a year from now, you're gonna start seeing that these retailers are driving content shoppable experiences. And I think if you go to walmart.com/live, it's a really great example of where that team has excelled so well to do that. And it's great to have a vehicle like TalkShop Live to power those experiences.
Can I just sell stuff in my closet? Can I just go live on TalkShop and start getting rid of some ties I don't want anymore? My team has told me I looked better without the ties, so
well, anybody can actually go live on the platform, because you can also sync your Shopify stores, you know, so that it's turnkey fulfillment.
Done deal. All right. A lot of
Look
stuff
for
about to go up
Brad's
on there right now.
coming to a screen near you.
Exactly. Brian Moore, Talk Shop Live co-founder and CEO. Thanks so much for joining us in studio.
Thank you guys for having me.
Definitely. All your markets action straight ahead, everyone. Stay tuned. You're watching Yahoo Finance.
What sector is going to perform the best during earnings?
What sector is going to perform the best? I would say probably not tech this earnings season, partially because it's run up already so far and the guidance needs to justify the valuations. Financials have done really well. We may have already seen the best sector during earnings season. I think energy actually has a good chance to do pretty well as well.
What sectors?
Earlier this week, Intel announced that it has mutually agreed to terminate its $5.4 billion deal to acquire Tower Semiconductor after China's antitrust regulators failed to rule on the transaction before a deadline set by the companies. Intel CEO Pat Gelsinger spoke with Yahoo Finance's Akiko Fujita to discuss the barriers and regulations behind the fallout of the deal and the future of M&A in the industry.
Unfortunately, we weren't able to get approval for the Tower acquisition. And as I would say, it was simply caught in this, center of U.S., China, or the geopolitics going on. We're disappointed by that because being able to acquire a foundry company like Tower would have accelerated. My ambitions to be a foundry weren't dependent on the deal, but they would have been accelerated by it. So simply put, I have to find other ways to drive the agenda because it's not likely that any major technology acquisition will get regulatory approval. And I think that's disappointing because M&A has always been a factor in how technology companies have been, building and moving their strategies forward. And it's unfortunate, that that's become a consequence of the current geopolitical tensions. And for us, it will slow me down in some aspects, but my strategy is not dependent on getting this particular deal done. It would only be helped and accelerated by that. And we're going to find other ways to keep moving our strategy forward in light of that.
If M&A isn't in play because of the regulatory environment, what are the other ways?
Business partnerships, winning customers, building capabilities organically. But I do think that this consequence of the M&A no longer being available for companies, and this isn't an Intel statement, this is an industry statement, I think is an unfortunate consequence of the current geopolitical situation. And, part of the reason that we've advised, I'll say, balance and temperance on both sides. We need the U.S. and Chinese collaborating, discussing with each other. These are the two largest economies in the world. I've been to China twice. I'm the chair of the U.S. Chamber's China Center because we believe there needs to be this bridge between these two important economies of the world. And, I've personally stepped into that role to help to play some of that bridging role. Obviously, visits by the various cabinet members, Yellen and Blinken recently, Kerry, and I think Raimondo later this month. All of these, I believe, are very positive steps. Let's at least have the real conversations going on.
You alluded to the fact that, this is an industry that is global. And as we have seen the geopolitical side of this play out, we've learned that, whether it is in Europe, whether it is in Asia, whether it's in the U.S., if there are barriers that are being drawn up, does that ultimately hurt innovation in this space? You look at the U.S. The U.S. has excelled in the design of chips. Manufacturing may be in Asia, but the U.S. provides the machines that allow for that. We've seen that in Europe, too. What happens when those barriers start to go up because of geopolitics?
I do think that it has a negative implication on the innovative cycle for the world in that regard. And I think, like in areas of AI, we've seen that the U.S. has led, right, profoundly. So all the major AI innovations, despite some declaring that wouldn't be the case, even just a few years ago, right, that China was going to win in that race. Well, hasn't worked out to be the case. I believe fundamentally because of the open, innovative, somewhat chaotic cycle that we have and the very aggressive venture and entrepreneurial aspects that we bring to the table. And I think that's best served by largely open global markets. And, and I believe that history has demonstrated that time and time again, that that's the best way to, approach global policy for markets. Semiconductors are one of the largest export items for the American economy now. One of our largest exports to China, only number 2 to soybeans. This is big. This is important. And if we're going to be a global manufacturer at scale, we need access to global markets. We need to continue to invest in our long-term research. Another aspect of the CHIPS Act was those long-term research investments as well. So let's be ahead today. Let's plant the seed corn to be ahead tomorrow. And let's underpin it with manufacturing at scale.
That was Intel CEO Pat Gelsinger speaking with our Akiko Fujita. We've got much more markets action coming up. You're watching Yahoo Finance.
In a surprise move, China's central bank cut 2 key policy rates after a broad array of data across retail sales and investment came in softer than expected on Tuesday. Will Beijing's latest move be enough to jumpstart the economy?
The data releases we've seen over the last week or so have been not just weak, but I would say outright alarming. Now they're cutting rates by 10 basis points. It's hardly a game-changing policy. I would say we're getting to a point of like incoherence in the policy framework, which is not really generating confidence. And you can see, okay, we had a rate cut and equities were down, right? So that's not what you want to see as a policymaker.
So China ramping up its easing efforts, more concerning economic data coming out today. How much trouble is China's economy in?
The Chinese economy is definitely under a significant amount of stress right now. The key thing to watch here is the real estate sector. This has been now the 28th month of declines in new construction activity since it reached its peak in 2021. And that has a big impact across the economy, not least on local governments who have relied on land sales to balance their books for years and are now under a considerable amount of stress.
Chinese officials are reportedly considering cutting the stamp duty on stock trades in order to boost the world's second largest equity market.
This measure would really be a boost for Chinese equities if they were to cut that stamp duty. A stamp duty is like a levy on stock trades, and this would be the first time that it's cut since 2008.
Chinese economy has been sputtering without doubt. Something that has bucked that trend has been Chinese crude imports. But if you look at everything else on the macroeconomic front, whether it be their exports, their industrial production, manufacturing activity, deflationary pressures, all of that is just big, bad news in bold letters.
I've been covering China for about 20 years. I've never seen this type of weakness where it feels like you have a real confidence issue, and that's certainly going to have spillovers into stock markets around the world. I'm surprised we have not seen more spillover. Like, given the severity of this consumer confidence crisis in China, I think we will see more spillover than we've seen to date.
It has been a huge week for retail, starting with retail sales for July blowing past estimates to rise 0.7% on a monthly basis, showing that the consumer is still strong. Then we had earnings galore. Home Depot, Target continuing to struggle in sales growth as consumers traded down. Meanwhile, Walmart and TJX excelled as they captured those cautious shoppers. Apparently that's hard to say. Cautious shoppers looking for deals. Joining us now with more on this week in retail is Jordan Holman, New York Times retail reporter. And you wrote about Target, among other things, this week and how they were not necessarily participating here, Jordan. One of the themes we've been talking about this morning is sort of the selectiveness, the discretion that shoppers are exercising right now, because it's not that they're not spending. It's just they're only buying certain stuff. So how are you sort of thinking about the bigger themes here?
Yes, I think it's part of this longer trend that we've been seeing over the past year, I would say, about people are buying groceries, they're trading down, meaning they're buying private label if they're buying groceries or apparel. And when you look at a store like Target and you compare it with Walmart just has a bigger leg up because they sell more groceries than a Target does. And then they do have lower price points relative to a Target. And so that's kind of that discerning nature. And even Walmart's CEO yesterday on a call with investors used that word. Customers are being more discerning, and that's why Walmart is winning right now in this environment.
I mean, we're looking at some of these shoppers with a household income of about $100,000, really honing in on Walmart here, especially when it comes to groceries. What's Walmart going to do to have to hang on to some of these shoppers, and how key are they to the bottom line?
I thought that was actually a really interesting point that Doug McMillon, Walmart CEO, made yesterday on the call. He said these higher income shoppers are coming into Walmart because they also are trying to save money where they can, and that is through grocery. But once they have them in the store, that opens up an opportunity to maybe sell them more discretionary items. Maybe you're selling them the clothes or an interesting like cooking supplies or whatnot. And so that's one strategy that they're using to bring them in. And then also, given that this is a back to school season, that's a crucial selling holiday that sets them up for Halloween, Thanksgiving, and Christmas to keep them coming back for that even more crucial selling season.
Jordan, we continue to talk about and hear from actually many of the executives who are trying to lean into cultural relevance in order to grow out the client base, the customer base that they're able to welcome into their stores and able to perhaps create a deeper relationship with. But then issues on the other side when they waver on their stances. And that was the issue for Target. How much did they shoot themselves in the foot this quarter?
Yes, as I'm sure we all remember, back during Pride Month, actually just a few days before June, Target was at the center of a boycott, anti-LGBTQ boycott, given their Pride merchandise, where Target moved a lot of the merchandise to the back of the store. And that issue came up again in their earnings, noting that in June, they did take a sales hit because in addition to the consumer pullback, there was obviously consumers who said, I'm not shopping with Target. The CEO got a lot of questions on the call about that. Where does Target stand when they want to, support a specific community? And Target said, hey, we want to be welcoming to all people. We learned from that, and we don't quite know what that will mean of how that shows up at Target. But I think what was clear is that cultural issue came up in a financial call. So it's all intertwined, and it's just putting a fine point on the idea that culture and sales and retail are all connected.
And Jordan, I want to talk about some of the discernment that we've seen on goods spending. Meanwhile, people are willing to risk it all to get their outfits together for Beyonce, for Taylor Swift, for Barbie as well. How much of this is going to be a blip? Being that you have these huge tours that people are spending on and really getting dressed up and spending on goods, how much of an anomaly is this, though?
Yeah, I was talking to our analysts about this yesterday. There is this idea going into the year that people would just pull back on spending a lot on goods. and that it would just be a summer and a year of experiences and the concerts and the movies. But there's a lot more dynamics at play. Yes, people have been spending a lot on those experiences as expected, but they're still leaving space in their budget to buy the groceries or buy some of the bigger items that we weren't expecting. And I think it still remains to be seen how long that can last, because we all do have a finite amount of money. But that is definitely one of these really interesting dynamics that's happened this summer.
What's the setup for the holiday season now, coming off of what we've kind of started to get some insight into, the back to school season, and then even further as we perhaps all get ready to dress like Barbie and Ken all over again once we hit Halloween?
Yes. So retailers are planning conservatively still for the back half of this year because student loan repayments have to start again. Interest rates are still high. Inflation is still stubborn. So we're not out of the clear yet. But when going back to Walmart, for them, they're like, well, that's actually, we play well in that people are already looking to save money. They'll come to us for all of those things. But a company like Home Depot, Walgreens, Target, they all said that they're planning more conservatively for the holiday season. And it will be a nice surprise if that is a strong one.
Certainly that consumer hanging in there, at least for now. A big thank you to Jordan Holman, New York Times retail reporter. Thank you for joining us today.
Thanks for having me.
Well, SpaceX reportedly saw surging revenue in the first quarter, allowing the company to turn a profit. That's according to the Wall Street Journal. The Elon Musk-headed rocket company posted a first quarter profit of $55 million on revenue of $1.5 billion. Meanwhile, the report says for the full year 2022, it posted a loss of $559 million on revenue of $4.6 billion. So what are we thinking in terms of an IPO soon? So, Julie, I want to get you to weigh in on this. Obviously, the Wall Street Journal getting a peek at some of these financial documents, something that we very rarely see here.
Yeah, and we've gotten a little bit of a shape around how big this company is before, but it's pretty astonishing the size of it as a private company. And what's also astonishing to me is there doesn't seem to be any kind of imminent pathway towards a public offering. In other words, it doesn't really seem to need it, right?
Yeah.
It doesn't seem to be having trouble raising cash or bringing in operating cash at this time. So. Why change?
If there's a way to think about SpaceX, if you're looking across the contracts that they're able to generate, and particularly where much of the funding has come in from and kind of the capital that's been infused into their operation, it's government contracts. Government contracts has amazingly helped up SpaceX to not only just get to and through testing and really showcase their findings to different governments who they're looking to get jurisdiction within. It's also gotten them to this nearly $150 billion valuation, according to reports now. I believe CNBC had first learned of some of the cash position or the financials and the valuation there. But as we think about what this company could mean for a IPO market that is waiting for companies like ARM to make debuts, that is waiting and has been waiting for quite some time for SpaceX to even decide whether or not it wants to make a public market debut. I wouldn't hold your breath on it. Elon Musk still does not like the thought of having companies that are publicly listed. Tesla is publicly listed, but he has been very vocal in the past about if he could take Tesla private, he would do so at pretty much a snap of a tweet, a post, if he could, as he tried to previously. And so all that considered, it's still up in the air as of whether or not SpaceX is going to make that debut that all of us would love to see happen, but perhaps is something that we shouldn't kind of bank on at this point in time.
Yeah, and to your point, in terms of the government contracts, there are a few big players in this space, but it really does seem like SpaceX is the dominant player in that sense. It certainly seems like from these numbers that it is the biggest player, Rochelle.
It's true. And clearly investors are playing the long game here. They're willing to wait it out, which is why we keep seeing these injections of cash. A cash injection of $2 billion from issuing stock. That was up from $1.5 billion in 2021. So investors really undeterred. We have to remember at one point, Tesla wasn't profitable either. So certainly backing what appears to be the long horse when it comes to Elon Musk and SpaceX. But IPO, as you mentioned there, it's potentially on the cards, but we have no idea when.
We'll say it's up in the air. How about that? All your markets action ahead. Stay tuned. I know, it's corny. We'll be right back after the break.
Will markets be higher or lower at the end of earnings season?
I think lower, at least if today's any indication. Netflix, Tesla, we had very high hurdles to jump over, and so far they're not. The banks, which had low hurdles, are jumping over them. So in general, with the valuations we have, probably lower.
Shares of Brinker International slightly in the green this morning. The restaurant operator, which owns Chili's and Maggiano's, topped estimates for earnings as revenue came in line with the street's expectations. Now, higher menu prices boosted sales at both Chili's and Maggiano's, though both chains saw a decrease in traffic compared to the year prior. Brinker International CEO and President Kevin Hochman joins us alongside Yahoo Finance Executive Editor Brian Sozzi. A big welcome to you both. So as we look at this earnings season, as we look at some of the data here, closing and overcoming that traffic gap versus the rest of the industry, what is the plan there?
Yeah, we're excited. Our turnaround is well underway. You know, we're seeing guest metrics significantly improve. We're laying down the investments into the business in order to start growing that traffic. So if fiscal 23 was for us was about really level setting that guest experience and getting us on the upward trajectory and improving restaurant operating margins, fiscal year 24 is going to be all about reinvesting back into the business to drive traffic. And we've announced on the call $55 to $60 million incremental this fiscal in advertising that's going to drive traffic. And the first waves of advertising that we did in 23 did a really, really good job of driving traffic and closing that gap. And that's one of the reasons why we're seeing accelerated sales growth versus the industry now, is because that gap continues to close. So we're very bullish about our current fiscal and the investments that we have in place to drive traffic.
Kevin, this is Brian here. Good to see you. It's been a weird week in all things consumer land. Walmart, good earnings. Target, not so good earnings. You guys did pretty well. Why do you think consumers are paying more for experiences and services like going out to restaurants and not buying more stuff for their home?
Yeah, it's interesting. What we're seeing is the people that are coming to the restaurants, they're excited to pay more, right? And so they're buying bigger bundles, they're buying more drinks. We're certainly seeing that in our mix numbers. So you shared earlier that the traffic was down, but the sales were considerably up. And what that tells you is the people that are coming are spending for experiences and they're spending for more premium things. And I think it's a function of coming out of the pandemic. I think people, they want to have more experiences, they want to be back together, and that's one of the reasons why we're seeing dining room traffic, up, and that's really helping our business because dining room traffic is much more profitable than off premise. So, I think it's going to continue. I think you're going to see experiential and experiences continue to be valued, and we're going to be there to service that guest.
And let's be frank, we're trying to have them margaritas too, Kevin, at the same time. Promotions, at the end of the day, though, that is a traffic driver, especially for a company such as yours. When you think about those traffic drivers, how long do promotions need to remain in place in order for you to see that full customer lifetime value over the timeline of a relationship there?
Yeah, thanks for that question, Brad. The way we think about pricing is we call it a barbell strategy. We want to make sure we have unbeatable value. No matter how much money you're willing to spend to come into casual dining, we want you to be able to service that Chili's with a great experience. So, we always talk about our $10.99 3 for me. That is the focus of our advertising for this fiscal, because we think that is unbeatable value across any restaurant chain, not just casual dining. But we also have things that we know Brian loved, like our $6 margarita of the month. So this month I'm going to do my shameless plug, the tequila trifecta, which has 3 different kinds of tequilas. It's a delicious margarita that I know Brian would love, but it's only $6. That is unbeatable anywhere. And so that's the example of, as long as we have price points that any customer can access, we know that we'll be able to win in this environment.
Yeah, Kev, I'm definitely down for 4 or 5 of those. No, absolutely. But let me ask you this. In terms of operations, there's a lot of folks, I think, right now in the restaurant space on improving operations. I'm sure you saw your competitor, Bloomin' Brands, has a new activist investor kicking the tires there, and I think he wants to improve the operations of that company. I look at Chipotle installing faster ovens so they can improve their throughput or just get people out the door quicker. What are you looking at next year in terms of Maggiano's and Chili's to just improve the profitability of your chains?
Yeah, so the way I approached the business, I started a little over a year ago, was just to go out and just listen to the restaurant teams to understand what are things that we can do to get out of your way so that you can better delight the guest and make it easier to do your job and make it more fun and more rewarding. And so we've been literally every quarter, we deploy those ideas to the restaurants, and things are getting a lot easier. In fact, last week we had our manager conference here in Dallas. So all of our managers come in, general managers come in for an annual conference. And I got to tell you, the excitement that they had for the business right now was incredible, because they know not only is it getting easier and more fun to work in our restaurants, but they are a big part of why that's happening, because it's all of their ideas. And what I told them, and they know this, is that simplification isn't a one-time thing. It's just our new way of doing business together. And so we showcased another 12 different simplifications that were coming out in the next 3 months. And there were all these people had their phones up, taking pictures of it. There was cheering, because they know that we're going to continue to be focused on taking their ideas and deploying the restaurants to make that guest experience better.
And we know that the consumer is still hanging in there, as we saw from July's retail sales. But on the call, we did hear CFO Joe Taylor talking about some skittishness in the consumer, at least at the beginning of the quarter. Do you expect that to become something that we see dotted throughout the rest of the year?
We don't know. We don't know exactly how that's going to play out. What I've talked to my team is that regardless of what happens with the macro, the most important thing that we can do is to have the best guest experience that we can possibly provide, because we're going to win market share in that scenario. What we know is that if the customer does pull back and they make less trips to restaurants, they're going to choose the ones they know they're going to have an amazing experience. So what's the indicated action on that? Have the best experience on the block. And so when we see our guest scores like server attentiveness, food grade, intent to return, all going in the right direction at all-time highs for the last decade, that gets us super excited about what's going to happen even if the macro does go a little bit negative, we know we're going to win market share. And that's what's happening right now. We continue to see market share growth, separation from the industry. And I think if we stay the course, let's focus on the things that we can control so that we can win market share over time. And then as the macro gets better, obviously they'll create explosive growth for our business.
And Kevin, you really have an incredible background in all things marketing, thinking back to your KFC days. And then now you look at Chili's, they have a really great storied history in marketing. Do you have to market specifically to, let's say, college students that are now going to have to start paying back their loans? Do you have to say, hey, if you have launch a program, if you have $20,000 in debt, come on in Chili's, you get some free fries? Are you thinking about these things?
Well, you've just given me a brief for the marketer, so I'm going to go back to George Felix and hand him that brief. But it's a great point. The fact that we have unbeatable value, especially for a younger guest, that's something that we got to make sure that we're telling that story. One of the things that's exciting about getting back on TV again is we know that that's how you're going to reach some younger people, and we have a message that will talk to them. When you have $6 margaritas of the month, or you have that $10.99 complete meal, where they know that they're not going to get nickel and dime at Chili's. They're always going to get an incredible meal at a high quality and something that they're excited about coming back for. We can win on that. So I think the more we can tell that story, I think the more we're going to see separation and the closure of that traffic gap that we talked about earlier.
Kevin, you see activist investor like Starboard Value take a share or a stake in one of your competitors in Bloomin' Brands. How do you keep activist investors out of Brinker?
Yeah, the thing that we're focused on is just improving our operations and making sure that we're growing restaurant operating margins, making sure we lower managerial turnover, all the things that are going to make us as strong a business as possible. And if we can continue to make progress in this turnaround, improve restaurant operating margins, improve the guest experience, continue to drive sales, and deliver the growth targets that everybody expects of us, I think we're going to be fine. But I think we just got to stay focused on the guest and stay focused on the team member. And that's how we're going to have a stronger business going forward.
Kevin, I tell you what, you keep them new margaritas on your desk like Wheel of Fortune posts or something, because we've seen a bunch of them at this point. You could definitely create a game out of that. That it would be dangerous,
at some point, you got to have me to the studio so we can actually serve you these margaritas.
The door's always open, Kevin.
It's right there. And we're pretty sure it's open right now. Thanks so much, Kevin. We appreciate the time as always. That's Kevin Hochman, Brinker International CEO, taking the time as always. Thanks.
Thanks so much, Brad.
You got it.
Thanks, Brian.
All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Have you tried pickleball yet?
I haven't. Someone gave me a single paddle, which I gave to my 7-year-old who loves it, and so now I apparently have to buy some more.
Done deal. All right. Getting the whole household involved. Love it. According to recent data from investment bank Barclays, activist investment has had a strong year so far, with over 133 new campaigns started globally in the first half of the year. That's well above the 4-year average of 108. And while Europe has seen that activity jump 41%, the U.S. has actually seen some of its campaign activity fall by 23%. But there's no stopping Starboard Value, a hedge fund that has made its name for being an initiator of some major campaigns here. From Macy's to Office Depot, Starboard Value has been active for well over a decade. Perhaps one of its most well-known activist campaigns, the complete overhaul at Darden's Olive Garden. The hedge fund presented a 294-page plan to cut costs and improve sales by improving food quality, eliminating non-Italian meals, and encouraging the sale of alcohol there. And according to an exclusive from the Wall Street Journal, a recent campaign against Bloomin' Brands, the owner of chains including Outback Steakhouse, shows that Starboard Value is not showing any signs of slowing down. And joining us now with more, we've got Yahoo Finance's own executive editor who stuck around just for this.
Yeah, can I just say one thing
Yes,
about this? So Jeff Smith, who's head of Starboard, I mean, the Olive Garden campaign really sort of put him on the map, right? But he's done many campaigns since then. But I love that Andrea, our producer who looked into this, went back and found that presentation.
It's great read.
I mentioned in our morning meeting about the salting the pasta water that was like a hallmark of that campaign. She found that page.
He also called out the
evidence.
headquarters halfway through. He pointed out that Darden built this new $152 million headquarters and overlooking the water. It was total just corporate largesse. But reality is, if you are a restaurant CEO, I'm not going to put Brinker in here. We're going to exclude Kevin Hochman in case he's still watching. But if you're a restaurant CEO and you've been underperforming, you should be inviting Jeff Smith onto the board. I've seen this guy change Darden, change Papa John's culturally and operationally. He is a massive unlocked value at a lot of these old school restaurant chains. He just loves restaurants. The guy knows what he's doing. He turns these things around. He's legit. And you look at Bloomin' Brands, and a source familiar with the matter tells me, they're really underperforming, and I think Jeff wants to see an improvement in operations in the company, like he wanted to see at Papa John's, like he wanted to see at Darden. And you go to the company latest 10Q guys. I mean, you see traffic down at Outback Steakhouse. You see traffic down Bonefish Grill, which is not one of my favorite chains, and you have Fleming's Prime Steakhouse, traffic down there as well, against the backdrop of a time where Fogo de Chao just got sold for $1.1 billion. Darden came out, bought Ruth's Chris for $715 million, and you have Outback trading at about $2.3 billion market cap. So there's probably a lot of value there to be unlocked at Bloomin' Brands. And just from a customer experience standpoint, I remember when Outback opened by me, it was something special. It was a 2-hour line. This was about over 10 years ago. The steak was awesome. Go there now, you get the drooping onion. It's horrible. I mean, it's a horrible experience. You go on the menu, and you get a porterhouse for $37. I'm going to go to Whole Foods tonight, and I'm going to get a tomahawk steak for $48. That's about 3 pounds of meat. I want a better experience. I'm going to go out and get steak. I'm going to grill it up myself and go and get a drooping onion here at Outback and some really bad steak where they've cut the sizes down on them. I mean, it's terrible.
But you won't
terrible.
You won't get the aesthetic of peanuts on the ground.
That's Texas Roadhouse, which is also one of my favorite chains.
Outback used to do that.
They used to do the peanuts.
Yeah.
Well, look, I think if you want to have a disappointing customer experience, you in fact go to Outback and overpay. And if you want to leave there smelling like fried food, go to Outback. But it's a disappointing customer experience. You see in the traffic numbers, you see in the sales. They have a lot of work to do.
Rochelle, what say you? Last word.
I will say it used to feel like a special experience to go to Outback. I mean, a steakhouse, it's in the name. I think the bar is set pretty high. And yes, it's sad. The blooming onion has lost some of its blossom.
Bonefish is dreadful fish. That chain just needs work, guys.
Is it just
I mean,
dry?
I eat at these places. I used to love it, but they're awful. They're terrible. Jeff, get to work, please.
The Wall Street Journal did not talk about specifically what Smith is going to push for over there at Bloomin' Brands, but obviously we have a bit of a roadmap here provided.
Please, Jeff, help these guys out,
Sazi.
please help them out, please.
All right, Brian, thanks so much for sticking around. We got to leave things there. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Fed officials descending on Jackson Hole next week for the Kansas City Federal Reserve's annual economic symposium will face the question of whether inflation is on a convincingly downward trajectory or whether more interest rate hikes are needed to bring down inflation. Inflation has cooled on a headline basis from a peak of over 9% last June to just over 3% this July. But stripping out volatile food and energy prices, inflation sits over 4%, double the central bank's inflation target of 2%. In his last comments at the Fed's policy meeting in July, Fed Chair Jay Powell wasn't convinced on inflation yet to let off the gas and said he needs to see leftover distortions from the pandemic on supply and demand ease.
Policy has not been restrictive enough for long enough to have its full desired effects. So we intend, again, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate.
Traditionally, Fed chairs have used their speeches at Jackson Hole to put forth major policy messages. This year expected to be no different, with investors hanging on Powell's every last word.
Welcome back, everyone. You're watching Yahoo Finance Live. And for this special Friday conversation, bringing your way, focus on cost of living right now, and particularly here as we've continued to see a lot of retail data come out over the course of this week. Some of the focus needs to still be on areas where inflation is remaining increasingly sticky. Housing is one of those, but also if you look at the main areas that consumers are going to be concerned about, it is what they're paying just for their cost of living in housing and shelter, but also energy, where that factors into what they're purchasing here. And we've got, of course, our panel that has brought together some great statistics. And we've got Danny Romero, of course, Diane King Hall, and Julie Hyman, yours truly, Brad Smith here. And as we think about where the cost of living is, there's so much geographical focus, but perhaps we start with where homes particularly have continued, and the prices there for shelter costs have continued to remain elevated. This is something you track on a day in, day out basis, Danny.
And housing has two categories, right? Where, we have houses like homes, and we also have rents. So they're a little bit separate. But let's go to the housing front specifically. Consumers are still very sensitive to rates. And now that mortgage rates hovered way north of that 7%, you're really seeing that pullback in demand. But another perspective is that today's rates are actually at a normalized level if you compare it to prior to 2008. 08. So that's kind of to give you some perspective. Wow, to us it might be a little bit of a shocker, but if we compare it to historical levels, it is about normal range, the 7%. But we're also seeing that the Fed's efforts are really to crush inflation is really happening in that housing market, right? Demand is slowing down. The applications to purchase a home hit the lowest level.
But are prices coming down?
That's the issue.
And it goes back to that inventory issue, right? The supply and demand side of things. And inventory is still a big issue, but I think on the housing front specifically, it's the affordable inventory.
And it's not enough. I mean, with rates continuing to rise, like that 7% level, should it get to 8%, that's not going to get any buyers in the market. I mean, people are sitting on levels like they got in a home at 3%, 3.25%. They're not going to sell their home now because they can't get something new for better. So they're going to stay in that starter home for longer. It's going to become more than a starter home. They may raise their kids through college there because of where rates are now. And the indications when we think about where the Fed could potentially go, and especially what we heard this week, in terms of the minutes, it could go higher, right? And that just continues to hurt demand within the housing market, right?
One way that an economist had kind of explained to me is that if mortgage rates go up, there's actually more inventory that gets onto the market because the cost of households goes up, and so that squeezes the person. And so if rates are lower, if mortgage rates go down, that means there's lower inventory because that spurs up the whole hoarding, right? I'm going to stay in my home. But that was a dynamic that an economist brought up of how he's looking at the market right now. So that's kind of an interesting perspective to look at too, right?
It's hard to see it that way. And I mean, we talk to economist after economist about if it's a buyer's market, is it a seller's market? And the point that many of them come back to is it's neither. You can't go anywhere really. I was shocked when I saw that number. I know from a historical perspective, it's certainly not the highest we've ever seen. If we go back to the 80s, and I don't know if all of us were around in the 80s. I know at least 3 of us were.
Don't age yourself. Don't age yourself.
It's fine. I mean, two of us. Oh, okay, right.
I was here.
You were in the 80s?
Yeah.
Okay.
First smidge of it.
Okay. Yes.
First smidge.
Happy birthday shout out on air. We have to do it. It's only apropos.
But, the cost of living has certainly risen a lot since then. And when we think about so many of the different factors that consumers right now are faced with, there's housing, there's your energy costs, and energy costs have receded from some of the highs that we had seen even a year ago. And you think back to even the retail sales data that we've seen, and that gives us a sense of how consumers are spending and where they're looking at price. And for the retail companies that have reported earnings this week, while volumes might be receding a little bit, that price that they're having to pass on, that continuing to remain elevated as well.
I keep thinking too about, there's the cost of living and there's the perception of cost of living. And while we tend to talk to a lot of economists who talk about disinflation, the rate of inflation is decreasing. I don't think that's how consumers look at the issue. If you go to the grocery store, you're not saying, oh, well, I'm only paying 0.2% more this month than I was paying last month. You're thinking year over year, you're thinking over time, and you're thinking more of a vibe, more of a feeling. I mean, if you look at the food at home prices in July on an unseasonally adjusted basis, they rose 3.6% year over year. So food in restaurants rose about 7% year over year. So even if you don't know exactly what those figures are, and even if it isn't going up at the same rate month over month, you still feel like you're spending more, and that is also going to inform your spending decisions in a number of different areas.
That's right, and we saw that play out in the numbers at Target versus Walmart. I mean, Walmart was the winner there in terms of the grocery spend, right? Walmart gets, we don't know what it is for the quarter, but annually they get about half of their revenue from grocery, right? So they're winning there because, to your point, consumers are spending on needs. They have to buy food. Even if inflation is still sticky when it comes to food, you have to. You can't not eat, right? Excuse the double negative. But Target, right, they only get, about a fifth of their sales from grocery. Look at their grocery section. It's much smaller. We had a conversation about that early in the week. And you're not, generally when you're going to Target, that's not necessarily what you're going for. And if you're making cuts to your budget and what you're spending on, you're going to cut out those non-essentials, right? So Target did a little bit better in beauty, but it wasn't enough to account for that slowdown in what they're seeing in other areas, right? Nobody needs to replace their throw pillows every quarter or whatever, right? You know, you're not replacing all your accessories, right? So Target needs to do something different. And we saw also the difference between Target and Walmart when it comes to e-commerce, right? So Walmart did better on e-commerce as well, right? And that was a surprise, right? They did 24% better, right? Whereas Target saw a slowdown. Target's talking on their earnings call about making some changes to mobile, et cetera. But again, Target also appeals to that more higher end shopper. And another kind of thing that we're waiting for and what this may do to quote unquote higher end shopper is the student loan payments coming back, what that's going to do to people's budgets, right?
Right. And so.
But will it though? Because a lot of the student loans have, I was reading your morning brief, Julie, and you really hammered that point home that is it really going to impact those budgets? I mean, I already got my student loan payment requirement, what I'm supposed to do. So, I mean, yeah, you look at it and you're like, okay, I see it. This is, I mean, it's lower for me than what I was paying before, but that's because I've been chucking away at it.
Well, so that's and that was the argument that I cited in that morning brief. It was from some Bank of America research that essentially said the people who suspended their student loan payments when they were given the opportunity to do so, are people whose household balance sheets were not in great shape to begin with. So in other words, when they have to repay, the marginal spend that's going to go away is smaller than it would be for someone who's in better financial shape anyway. So in other words, it's going to be just a smaller hit. Yes, for that individual, it's going to make a difference. But if you look at the wholesale effect on consumer spending, it might not be that huge. Now, take it in concert with the work down in excess savings and some of the other effects, maybe you'll have a difference. But I also go back to the idea of the consumers being more choosy. You know, when Walmart talks about high net worth consumers spending at Walmart, trading down to Walmart, you know, it's not necessarily because those folks cannot afford to shop at a Whole Foods or a Target or wherever else. Maybe it's because they took that family vacation to Europe. And so they're reallocating the money. So yes, the cost of living for everyone has gone higher, but it doesn't, but spending hasn't necessarily on a real level, real spending, if you account for changes in inflation, that picture is not as clear.
And so, so just to kind of bring this all together here, because there's a few topics that we've talked about. We've talked about the cost of shelter. We've talked about the cost of just transportation, kind of getting around, and gas, but also the necessity in food as well. But what does this all come back to in your cost of living? It's how much you're making, which you were starting to get into a moment ago. And if we're looking at where that marries up to the data that we've already seen, the August 4th reading even in the survey of consumers, as they had noted there, the environment, the economic environment, consumers are perceiving little difference from last month, substantial improvements relative to 3 months ago here. And what does this come back to? It comes back to how much they're making and where the job opportunities to continue to come forward. And so even within that, we've been continuing to have the conversation about where there's been so much investment in the U.S., whether that is making sure that there are more chip factories that are getting brought online. We just had a conversation this morning about industrials and where they need to backfill for some of those jobs too. And so then you kind of see this circular motion of, well, if the wages need to still continue to go higher in those categories that are still hiring heavily, how does that still continue to add to the broader inflationary picture where companies are saying, all right, well, if the employment environment is strong, then people are still going to be willing to pay up just a little bit more.
Yeah, and I mean, that is a good point, especially when you think about how robust the job market has been. We've continued to see it hold up in the front of expectations for it to weaken, and it hasn't, you know, and that begs the question about what direction are we going in terms of this fight against inflation, right? Are we going to continue to go higher? Is it, again, also that theme that we've heard, higher for longer? And then what that does in general to the economy, right?
Right. I mean, at this point, you have a lot of economists saying that the Fed is going to cut rates next year just to bring rates more down to a normal level. If indeed, though, you see the same trajectory we've been seeing where wages remain relatively elevated, because most of the folks we're talking to are still seeing it might not be as hard to find workers, but it's still not easy for them necessarily to find workers, particularly in the services industry. And then you can add on the new chip factories and all of that onto that. So if you're going to see that persistence, are you going to have the Fed with the ability to cut rates? It's far from a certain outcome at this point.
Yeah, and definitely not right now.
Wanted to say one thing that we haven't discussed is the population. I mean, we've been growing. I mean, the pandemic babies, that's also another factor that I think we weren't seeing before, when now we're seeing it. Right now we have a newborn. People, I know my friends have newborns. And so that's something to consider in your budget too, right? I mean, if before you were doing okay, now you have a newborn or two newborns, there's some child care costs is really, household formation is happening. We're seeing that more so now than obviously during the pandemic there was, and also immigration is part of this too, right? So I think those are all other factors to factor into this living cost equation.
Yeah, and child care costs, by the way, are not slowing down.
Yes,
no,
they're not.
So that's something
we've
else
had that.
yes.
Like just the conversation about that, and and what people are choosing to do when they figure out how they're going to manage their budget around that, right? It is expensive. Childcare is expensive. So we had this conversation about some people doing things like taking their kid with them to a bar, which there
was
some
just an
bars
article
that
about
are,
that, wasn't there?
Yes, some bars are family friendly.
You're in New York, I feel like.
I know my buddy took his child.
Right?
I mean, stick a baby in a carriage. You can take them anywhere. Trust me.
Yes.
When they're small enough,
take them with
they're portable.
you. Exactly, they are
With
more
a pacifier.
portable than.
You just got to be able to check that sippy cup in a
make
good amount of
sure.
time
That's
too.
right.
Absolutely. I believe we got to leave things there on the day before things get a little too
But wait,
saucy
we got
out
one
here.
more thing to say.
Yeah, what's that?
Happy birthday,
Oh my
Brad.
God! Oh goodness, with the hat and everything. You guys are too much. Wow. Yahoo Finance Purple. Happy birthday lettering. Love it. Thank you guys so much. All right.
Have a great weekend, everybody.
Bye, everybody.